Hi, we will talk about notes receivable. The first of all, we need to know the difference between notes receivable and accounts receivable. Now, in accounts receivable, normally it's less formal. So when we sell an item to a customer and we allow him to pay sometime in future, usually we do not ask him to sign too much documents. Plus, that we're not normally charging them interest on top of the amount they owe us for the services or the items we sold to them. But with notes receivable, usually we ask the customer to sign a promissory note for the amount that they owe us, and that amount might be either a service that we provide them, for a service that we provide them, or for an item that we sold to them, or maybe we just lend them money. Maybe we're the bank or a financial organization. So usually we ask them to sign a promissory note, promising us to pay, plus that we normally charge them interest on top. And that's what makes notes receivable different from accounts receivable. So three main items that we need to know when it comes to notes receivable. First of all, it's the principal amount. That's the amount they owe us without any interest. That's the amount. The other thing is the interest rate. There must be an interest rate. Maturity period. For how long? How long are you going to give the customer before they pay you back what they owe you, including the interest? So let's take an example here, and we're going to record journal entries based on that. Let's say that we lend a customer $1,000. So the amount is $1,000, and let's say that the interest rate was 6%. And then keep something very important in mind, that interest rates are always presented annually. It represents 12 months period of time, or 365 days, or usually in finance we use 360, not 365. So 6 months, and 6%, and then the period of time, we will just make it 1 year. It doesn't have to be 1 year. It can be less than that or more than that. It can be a couple of months. Okay, and the 6%, it has to be prorated to a smaller percentage if the period of time was less than 1 year, and then we're gonna use that today. All right, so first of all, let's record the journal entry for lending $1,000 to the customer, or maybe provide them a service worth $1,000 and then make them sign a promissory note to pay us 1 year later the 1,000 plus 6%. And then let's consider that we lend them that money on September 1st. And then let's assume that we close our financial statements annually at the end of the year, at the end of the year, calendar year. So December 31st is where we close the statements. Okay, so on September 1st, we will have to debit notes receivable. So notes receivable, it's an asset just like accounts receivable. And it increases with a debit just like any other asset. And then we're going to credit cash. Let's say that we lend them money. So we give them cash. So our cash is decreasing, so that would be a credit. Okay. Don't forget that when you credit an amount, you're going to skip it. You're going to shift it a little bit to the right. We're not going to consider any interest here because it's still the first day. It's the day we lend them the money. So there's no any interest that has been accrued yet. So we just have to record the principal the day we lend them the money. Now, later on, we have to record the interest that accrues for that amount that we lend them, and that will be the best time to calculate the interest and record it in a journal. Now, as we said, they close their accounts at the end of the year, December 31st. That means we have to do an adjustment. We spoke about adjustments in Chapter 4, and we're going to talk about it again today. So on December 31st, we have to make an adjustment for the interest that we are going to receive from them at the end of the maturity period. Yeah. So if it is 1 year, that means it's going to mature for payment on August 31st the following year. Okay, so let's say that was September 1st, 2016, and then they will get back to pay on August 31st, 2017. However, on December 31st, 2016, we have to record an adjustment, which is incurring the interest revenue that belongs to 2016 itself. Because that 1 year, it's 4 months of that is going to be in 2016, and then the rest of the period, which is 8 months after that, will be in 2017. Between September 1st to December 31st, 2016, that will be 4 months. That belongs to 2016 financial statements. And then January 1st all the way to August 31st, that will belong to 2017. So the interest that will accrue for that 1 year, we have to split that between 2016 and 2017. And then the amount that will incur for interest, it's going to be a revenue because that's cash in. So we have to put 4 months of interest revenue in 2016 and 8 months of interest revenue in 2017. So at the end, and that's considered an adjustment when we record interest revenue end of 2016 because it belongs to 2016. All right, so the name of that account, because we're not going to get cash from the customer at the end of 2016, we have to wait until August next year. So we cannot say debit cash. But however, that amount now is we consider it officially owed by the customer to us for interest. So we will call that interest receivable. Interest receivable. It's a receivable account, so it's money owed by a customer to us. For what? For interest. So we're going to call it interest receivable. It's different from interest revenue. Okay, and then we need to do our math. So interest receivable for 4 months between September 1st and December 31st. So this is how we calculate it. The principal is $1,000. We multiply that by the interest rate, which is 6%. And remember, this is an annual interest rate, so we have to take a portion of the 6%. So we multiply by 4/12. Okay. Or you can do 120 over 360. All right. So 6% of the 1,000 multiplied by the 4/12, that would be $15. Okay. Because 6% of the 1,000, that's $60, and then 1/3 of that is $15. So the interest receivable is only $15. And then we're going to credit revenue. What kind of revenue? Interest revenue. And again, we did that end of 2016 because I want that revenue to show up in the 2016 income statement. If you wait until next year, it's not going to show up in 2016 income statement. It will be in 2017. Okay. All right. So that was the adjustment. And then the day of maturity, which is August 31st, 2017. Okay, on that day, the customer has to come back and pay the $1,000 plus the interest. How much interest is he going to pay us? Well, 6% of the $1,000 for 1 year, which is going to be a $60 interest. So the cash so we have to start with the cash. The cash will be received on August 31st is going to be the 1,000 plus the 60. So that would be 1,060. And then we have 3 accounts to record in the credit side. And let's think about these accounts. What accounts do we have to use? First of all, notes receivable is going to be canceled because we're going to get cash. So no more notes receivable, so that has to decrease. So that would be a credit to notes receivable for how much? For the principal. Be careful. Notes receivable is always going to have the principal, not the principal plus interest, just the principal. There will be a separate account for the interest, which is interest receivable and interest revenue. Okay. All right. So the next account that we have to credit is the notes receivable that the interest receivable that we debited at the end of 2016. So once you get those $15, then the customer doesn't owe you interest anymore. So that has to decrease. Interest receivable has to decrease by $15. There's one more account, which is the interest revenue at the also would be credited because it has to increase by how much? It has to increase by the interest revenue that belongs to the last 8 months, the 2017 months, which is January 1st all the way to August 31st. The interest revenue for that is going to be recorded right now for 6% of the 1,000 multiplied by, let's do that over here, multiplied by 8 over 12, so 8 months, and that would be $45. Okay, so again, we're gonna credit notes receivable, for $1,000, that is decreasing, and then credit interest receivable, that one, because it's converting to cash, so it has to decrease because there's no more notes receivable of $15, and then one more credit, which is the interest revenue of $45. Okay, so remember that your total debits has to equal your total credits. We have a debit of 1,060, and then the credits, if you add all these amounts, you will get 1,060. Okay, that's all for this video, and wish you all the best.